Well, hey there, everyone. Happy Thursday, April 16th, 2026. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from an unseasonably beautiful, kind of sunny, partly cloudy-ish day here in Redmond, Washington. We actually had snow in parts of the east side of Seattle yesterday, which is kind of strange. Snow overnight, but it's all melting. We'll get highs like in the around 50, 52 or so. But interesting weather patterns as always. Hope you guys are all doing well. Still, hopefully enjoying this resilient market move above S&P 500, 7,000. If you missed yesterday's episode, you missed arguably one of the finest trumpet performance I've ever done on the show, and that is the only one. But it was a lot of fun after months of anticipation to finally, little fanfare to announce that brilliant move and eventual move above S&P 7,000. Now it's going to be all about whether we hold that particular threshold. Today we're going to talk about market conditions as the S&P made yet another new all-time high. Ended up being kind of a nice late inning surge. Last hour and a half really got it done. Wasn't a huge directional move, but we're continuing to see upside in risk assets. We're continuing to see lower movements in volatility. We've got a number of kind of hopefully thought-provoking charts to help you think here. And I would say one of the interesting features of this particular moment in market history is the S&P has made new all-time highs. The equal-weighted S&P has not yet made new all-time highs. The number of new 52-week highs is not particularly high at the moment. So what that means is this is very much a mega cap growth driven bull market. Although there's some other areas of the market starting to show some improvement, we'll try to highlight some of those as well. By the way, we're live streaming on YouTube, X, Facebook, and LinkedIn. I appreciate you, all of you guys tuning in live. I see some familiar names and handles and faces in the chat, and I appreciate it. Any of those platforms on which we're live streaming, if you're tuning in live, you can use the opportunity in the comments section of those platforms, and I can see them here as we live stream. If you're watching the replay on our YouTube channel, hey, thanks for watching there too. And drop your questions there. We're planning an all mailbag episode on Friday. That's tomorrow's episode. And we would love to answer your question on the air. Nothing's out of bounds. Ask away. All right. As we look at market conditions here today, honestly, it was kind of a choppy session. Briefly higher open, turned into a move just below the zero level. But the afternoon, most of the time was spent in the green. Last hour and a half is when we went from flat for the day to slightly higher for the day. It was enough for all the major indexes to move, to finish in the green. The S&P 500 up about 0.25%, so new closing high at 70.41. The Dow up about the same. The NASDAQ slightly higher. Mid caps and small caps all about the same. But NASDAQ still the top performer of that basket. The NASDAQ 100 up 0.5%. So not, these aren't huge numbers, but again, that theme is still playing out where we have growth over value. Mega cap growth over everything is sort of the general theme that we're gonna continue to reflect on here today. Volatility continuing to drift slightly lower. The VIX finished today just below 18. So as long as we're in the teens, as long as we're below 20, that is a low volatility environment. And that's honestly what most bull markets are usually made of. It's very rare that you have the market making meaningful gains with high volatility. Low volatility is a little more common during an accumulation phase, during an uptrend phase. That's a good sign. VIX remaining below 20, I think would be one of those great kind of gut check indicators just to make sure that the conditions are still favorable for the market going higher. Looking at the fixed income markets, we've got the 10-year yield and the rest of the yield curve generally drifting higher today. The 10-year yield just above 4.3%. The long bond yield just above 4.9%. Quick shout out to Thomas Urano of Sage Advisory. I interviewed Thomas for the Market Misbehavior podcast. We just released that episode this morning. Please check that out. It was a really cool conversation. Thomas is a fixed income portfolio manager. He spent his career analyzing the fixed income markets. I was able to ask him any question I've always wanted to ask a fixed income portfolio manager. I tried to get him in there. So, are bonds really a safe haven? What do you make of the correlation between stocks and bonds? What about the new Fed chair? How does that change the picture? all about the fixed income markets and how they related to and have evolved, around the events in the Middle East. So if you've had challenges figuring out things like the yield curve and the interest rates and what they all mean and how they relate to other things, this is a kind of mini masterclass in the fixed income markets. You can find that podcast interview on my YouTube channel and also on all the podcasting platforms. So rates generally moving higher today. The TLT, which looks at bond prices, was drifting lower through the course of the day. So, stocks and bonds have generally been moving together, but we're starting to see that change a bit this week. Once again, we've got stocks moving higher. We have bonds moving lower, bond prices. Dollar index up slightly. It wasn't a huge day for currencies, but the UUP, which is a bullish dollar ETF, did move to the upside a bit. Looking at the commodity space, a bit of a disconnection between precious metals and other risk assets, other things like equities. Today was sort of an interesting day. You had crude oil prices moving higher. The USO up 2.7%. Natural gas prices up as well. Precious metals like gold slightly lower. Silver down a little bit more, as was copper. So while stocks were up, sort of a different feel in the commodity space, where energy prices were higher, metals prices were lower. And we've generally seen the opposite, right? When stocks have been moving higher, we've seen gold and silver rally, and that's been when crude oil has gone down. So things starting to shift around a little bit here in the new year, and in the new week, that is. And what I would say is what's interesting to think about is that I think this comes back to the leadership, right? This hasn't been a particularly broad advance, particularly this week. We're seeing a lot of growthy stuff doing incredibly well versus other areas of the market. As a result, a bit of a shift here in the commodity space, something to keep an eye on. In the cryptocurrency world, generally a decent day. Bitcoin is currently just pushing right above 75,000. That's the threshold I've been looking at as generally avoiding Bitcoin unless it can secure a move above 75K. I'm going to start looking tomorrow. Maybe consider adding a position in my own portfolios, given the strength that we've seen. Enough of a follow through that it feels like that might be the beginning of something further. As you look further down the list of the top 10 coins tracked on the stock charts platform, you can see most of them in the green today. All right. Looking at the sectors, we can see the energy sector, the XLE, up 1.5% today, and that's the best performer. So I've been all talk about growth over value. Value at the top of the list today, at least one of the value sectors. Energy, a bit of an outlier, right? Because the rest of the value sectors were generally weaker today. But the XLE at the top of the list, up 1.5%. Crude oil prices moving higher, certainly I would say the story there. Communication services, number 2, the XLC. Technology, the XLK, number 3, up just over 1.1%. We can see that 7 out of the 11 S&P sectors finished in the green. On the downside, healthcare, the worst performer, down 0.8%. Industrials and consumer discretionary both down about 0.5%. And that sort of pattern with industrials and healthcare has definitely been a noticeable trend here in the month of April. While other areas of the market, things like communication services and technology have been, a lot of breakouts, a lot of improvements. Healthcare still lagging generally, industrial still lagging. Some of the better charts were in industrials, but now lagging behind the growthier sectors at this particular moment. So breadth was not great, or it was pretty good, depending on which universe you're considering here. And that's what this breadth table is going to show you here. We're looking at the advanced decline data on the New York Stock Exchange at the top. Almost 50% of the NYSE were up today, 47% down. That's almost dead neutral. That's a coin flip. But compare that to the S&P 500, where 59%, almost 60% of the index was up versus 40% down. In the small cap space, closer to neutral, 52% up to 47%. So what gives here, where you've got different breadth with the S&P's breadth looking a lot better than in other areas of the market. Again, this comes down to leadership, right? The S&P 500, out of all of these indexes, the S&P 500 is kind of the, I mean, well, the Nasdaq's really the growthiest, but the S&P 500 definitely has a growth tilt. It's interesting though, and this is kind of a head scratcher. I'd really have to look at the data now that I'm thinking about it. NYSE 50% up, Nasdaq 48% up, but then the S&P almost 60% up. Seems like a crazy comparison. But hey, that's what the data is telling us. So something to think about. We'll have to look there at what are some of the names that are in the S&P that aren't in the NASDAQ, that are NASDAQ name, or that are NYSE listings. I guess we'd have to start putting our head together on that. That's an interesting one. Okay. Down here across the Magnificent Seven growth names, we've got Microsoft up 2.2%. It wasn't necessarily a great day for the Mag 7. You can see that about half of them were down. NVIDIA, which has had a pretty resilient move out of, sort of trying to break out of this congestion area, down about 0.25%, as was Alphabet. Tesla down a bit after having a pretty good run higher. Apple's been, I would say, by far one of the least impressive charts in this basket. But others like Tesla have had pretty good runs. They're all kind of pulling back a little bit. What's interesting is you have Alphabet, testing new all-time highs. You have Tesla testing the 200-day from below. So a number of these charts have kind of rallied quickly up to key resistance levels. And I think it's an open question as to whether they have enough momentum to power through. Not happening today. Microsoft and the rest of the software space really, just quite a left turn and really, showing some strong price action since the end of last week and continue to push higher today. And that's the best performer of the group here. All right, I think that's it for the front page here. We're going to look at the heat map. I do see a number of questions coming in. Some candle questions. We can grab one of those for sure. Hey, why not take a question now? Rustin Rogers, it looks like a spinning top on the NASDAQ composite today. Tomorrow and Monday could be interesting. Let's look. So the NASDAQ composite, that is CompQ on stock charts. Yeah, I see what you're saying. So thanks for the comment here. So a spinning top is basically where you've got the small the open and close very close to one another, ideally a long upper shadow, long lower shadow. So it's kind of like a doji candle, kind of looks like a cross on the chart because the open and close are identical. If you've got the open and close spread out a little bit and ideally kind of a longer range from high to low, that's called a spinning top. And that really is, basically a reversal pattern suggesting that there's some indecision and that there's a lot of volatility, but not a lot of directional move, right? Compare a day like yesterday where you open at the lows, close near the highs, clearly like a bullish day, right? Accumulation through the day from open to close. And that happened on Tuesday and on Monday. So Monday, Tuesday, Wednesday, all these big accumulation days, closing near the highs after you open near the lows. That's what makes today look so different because finally we opened higher, and instead of having another one of these, we actually just chopped around a little bit and had a lot of noise. But by the end of the day, we really didn't gain that much. So it does imply sort of a bit of a stalled out move. Kind of an interesting one for sure. Indexes are always a little weird. So to be honest with you, when I'm looking at candle patterns, I generally avoid indexes, just for the record, and use ETFs because ETFs have a proper open and a proper close. A lot of indexes, and this is an old, this comes from years and years ago when the open was calculated a little bit differently. But a lot of times you don't have a lot of gaps on the index charts because of how the opens were calculated. And so I got used to using ETFs. And so the QQQ, though, similar vibe to what we just saw. 3 big up days, and then today's kind of what we call a spinning top candle, or these long, sort of volatile days with not a lot of directional gain. All right, let's continue on here. We'll take a question or two again at the end, but thanks for keeping the questions coming here. Looking at the heat map, so what's interesting, this is one of those days where I feel like there are certain areas of the market that look pretty good, but there's plenty of things that were not great today. And this is one of those where the chart of the index doesn't feel like the heat map, right? When you look at the chart of the S&P, it seems pretty constructive because we're pushing above the previous resistance. We're making new all-time highs. Certainly seems like there's nothing but optimism priced into the chart. But you look at the heat map today, and a lot of things were down. A lot of things were not part of today's move. What was part of the move? Obviously, the technology sector, and you got to remember that's about a third of the S&P 500 is just technology companies, a little over a third. So all those names like not Alphabet, Oracle, AMD, Intel, Cisco, Arista, SanDisk, Texas Instruments. These are all large cap technology companies just continuing to push to the upside. AMD is just accelerating. A number of semiconductors on there, a number of software names, obviously, in there as well. So I would say just a number of stocks continuing to push further upside. Interesting that on a day like today, the old school telecoms, which are really more the defensive area of the communication services sector, actually had a pretty good update. You can see AT&T, T-Mobile, Verizon, all up 3.5%+. So that's a kind of a different vibe than we've seen. We've generally been noting Alphabet and Meta and Netflix showing a lot of strength. And then the defensive areas of the communication services sector, which are really like the old school telecom names. If you remember years ago, there was a telecom sector and it was a super small sector, and it was AT&T and Verizon and then a bunch of smaller companies. And that eventually they redesigned and created a new communication services sector and grouped the internet names and the entertainment media names and the telecoms all as a new kind of sector. So AT&T and Verizon went from being like one of the classic defensive sectors, telecoms, to now being in kind of an offensive sector. So it's a bit of a different feel. Now AT&T and Verizon, their businesses have evolved, of course, and it's a lot about mobile and communications outside of just your landline. But it's worth noting they generally are lower volatility, higher higher income paying kind of names, classic defensive kind of positions. So those were up today as the S&P made a new all-time high. As much as we're looking at earnings this week and really over the next couple of weeks, and the financial sector has been sort of the initial sector to get a bulk of their earnings out there. A lot of them kind of pulling back here today. Three of the big ones: Morgan Stanley, Bank of America, Citigroup, all kind of pulling back. Morgan Stanley and Citigroup just made new all-time highs yesterday. They're not down a ton, but they're kind of pulling back off of those highs. So in an environment like this, where you have the market breaking out, it's always interesting to me to see which stocks are continuing to show strength along with the benchmarks, which ones are not, like which ones are just not a part of the bullish story. And I would say at this point, even though the earnings have been fairly decent, and I was just interviewing Nick Raish, that'll be the next episode of the podcast coming out tomorrow, maybe Saturday. We'll probably put it out over the weekend. Nick is an earnings expert. He's awesome. We had some really good conversations about earnings. He was mentioning just under 10% of the S&P companies have reported earnings already just in the first week. And generally they've been very strong, particularly the estimate revisions have been pretty positive, which is what he considers the most important area of the market. For what it's worth, I'm not really seeing a lot of great price momentum, at least today, with the financial sector, sort of a lack of upside momentum. Industrials feels very much like a mixed bag at the moment. Healthcare seems very mixed. So if you look at the heat map, a lot of green, a lot of red. Energy, though, I think surprisingly part of the strength here. Defensive consumer staples, actually, with a lot of names moving higher. BG making a higher low. Pepsi, which is pulled back to around 150, starting to turn higher. So for a day that was really about another break to new all-time highs, the stuff that's up is kind of unique, right? It's not just offense versus defense. I would say it's very much a mixed bag, opportunistic combination of all these different sectors and themes. A little bit of everything here. Interesting. All right. Albemarle, though, by the way, ALB, nice breakout above $200 a share for the first time. Noticing some strength in the material sector, even though it's not been one of the better performers here recently. All right. We're going to continue on with some charts that I've hand selected to review with you. Before we do so, a couple quick announcements. Number one, I'll be doing a webcast next week. On Wednesday, April 22nd, I'll be doing a presentation called Follow the Leaders, relative strength, breakouts, and better ideas. We're going to talk particularly about price momentum and focus on where and how we can find opportunities in this kind of environment. We're going to be looking at relative performance, which is basically how stocks are performing relative to their peers. I think that's essential to really think about what's not just looking good in terms of price action, but what's doing better than the benchmark. We're going to talk about scanning ideas. I'll share with you some of the scans that I run regularly. We'll run them together and look at what potential emerging leaders we can identify. You can sign up for that free webcast coming up next Wednesday at marketmisbehavior.com/leaders. And again, that's coming up next Wednesday, April 22nd, 1 o'clock p.m. Eastern, 10 a.m. Pacific. Also want to give a shout out to one of our partners, EPS Momentum. I've used the platform. It's a relatively new platform focusing on price momentum and earnings momentum. I know the founder of the company. Used to work with him back in our Bloomberg days, and I'm pretty impressed with what he was able to put together, looking at this combination of strong price and strong earnings potential. It's filled with some quantitative models that are proprietary because they've developed some ways to analyze price and trend and also earnings and trend. Has great data on earnings-related issues, but also focuses on the changes in earning expectations, which a number of the experts that I trust the most tell me that's kind of where you want to focus your time. You can learn more about this platform called EPS Momentum at marketmisbehavior.com/EPS. And you use my link there, you'll get 30% off. And again, marketmisbehavior.com/EPS. All right, let's look at some charts that I've hand selected here. I see a number of questions. Keep them coming. We'll get to a question or two before we finish. Here we go. Chart of the S&P 500 continuing to show strength after yesterday's dramatic drive above 7K. What's interesting about this week is Monday, Tuesday, Wednesday, all big up days, right? Closing near the highs of the day, similar to the chart we just looked at with the NASDAQ and that spinning top candle. You got a similar kind of thing happening here for the S&P 500. So today was different, right? If you look at what happened, even though the returns were good, right? The S&P closed higher. Look at the trading day, right? Look at the bar that represents Monday's session, the bar that represents Tuesday's session, and now Wednesday's session. This one looks different, right? And we can see that on the heat map where there are a lot of things that were up, but there are a lot of things that were down, a lot of things that were kind of flat. We can see that in just the, the general trend, right? In things like breadth indicators, it really didn't move significantly higher today. It was more neutral. So, I'm not ready to declare that this is the top and this is a reversal day or the peak. Does it indicate, a short-term reversal? It usually does, right? This kind of candle pattern, especially after 3 big up days like that. Today feels like we've stalled out a little bit. Most likely that would suggest some weakness here over the next 1 to 3 bars. That's what that candle would generally tell me. Having said that, I don't think 7,000 is like the most important level of resistance. Given the acceleration that we've seen, I wouldn't be surprised if we get some sort of pullback here. That would actually be completely reasonable and normal, especially after the acceleration we've seen, not just in the S&P, but in some of the charts I'm going to show you, some of the growth names that have just lights out positive since the gap higher, a week and a half ago. Having said that, what do we pay attention to? I'm now thinking of 6,800. Which was a significant level of support and then became, I think, a decent upside objective. Now that that's broken, I think that's a reasonable pullback. And what I mean is anything above there should probably be considered still fairly constructive. We start breaking below 6,800. That would be an initial line in the sand for me where I would maybe be a bit concerned. Also worth noting, the RSI is overbought at today's close. The last time the RSI was above 70 for the S&P 500 is all the way back here in October of 2025. So if you look back to the left on this chart, look at the times when the RSI was overbought. Being overbought is not necessarily a bad thing, right? And it became overbought a bunch of times in July, August, September, October, even though the primary trend was positive. And that's actually pretty common, right? The RSI usually doesn't become overbought unless we're in some sort of accumulation phase because there has to be enough buying power to push the momentum up that strong. So I think generally that's probably a good sign for stocks that the RSI is overbought. But if you look in the short term, a lot of the pullbacks that we had during this uptrend kind of happened right after we were in the overbought region and then came out of the overbought region. That's why we look for that as a sign of maybe a short-term pullback, especially after a big run higher. So could be setting up for a bit of a tactical pullback, maybe going into the beginning of next week. But overall, again, primary trend appears constructive given the strength of the momentum and certainly just the strength in price. Now, as always, I was taught to think like a contrarian. If the market's going higher, look for the evidence that it should not. If the market's going down, look for evidence that it should start going higher. Always be thinking about what could change this story of the current trend. And that's why I often highlight what the opposite story might look like. It's how I was trained. And it's been very helpful because it served me well, because I'm always trying to think of an alternate hypothesis. And then when something different happens, I'm kind of ready because I've kind of thought through it already. So what concerns me right now? Well, what does not concern me is that the S&P is breaking out. And that's the top panel here, right? We keep making new highs. That's bullish, right? With nothing else matters as much as the fact that the index is going higher. Now, what we have to remember, though, is we can also go a level lower and start to validate the breakout, validate the move in the S&P by seeing what other things are also performing. And that's where I would say it's less than ideal at this particular moment. For example, the equal-weighted S&P 500, which is that middle panel, has not broken out. We're still below the high from late February. The equal-weighted NASDAQ 100, which is obviously a group of large cap growth stocks, mostly mega cap growth stocks, also has not quite broken out. It's really close to breaking above that all-time high from the end of January, but still not yet. So the cap-weighted S&P has broken out. Equal-weighted versions of the S&P and the NASDAQ have not quite broken out yet. Now, this isn't to say that that can't happen. I think that's one of those things, one of those confirmation signals we should be looking for here in the days and weeks to come. But it's worth noting that we haven't had that confirmation just yet. I would also say there's not nearly enough new all-time or new 52-week highs for me to get super excited yet. This middle panel is the number of stocks on the New York Stock Exchange making a new 52-week high, and then in red, the number making the new 52-week low. In the bottom panel, the number of stocks in the S&P 500 making a new 52-week high, and then in red, the number making a new 52-week low. There's about 4.5% of the S&P made a new 52-week high today. That's just not a lot. That's a relatively small number. As a matter of fact, that's about what we had all through March and into early April, about the same, right? On those up days, we would have about 4 to 5% of the S&P making a new 52-week high, and we're kind of getting that same thing. So there hasn't been this big influx of more and more names breaking out. That's kind of what we saw back in January and February, where at peak we had over 20% of the S&P in mid-February making a new all-time high. So that's healthy breadth. That's broad participation. That's a broad advance driven by new 52-week highs. So I would argue for a sustainable gain beyond what we've seen so far, we need more individual names achieving their own 52-week highs. I'm just not seeing enough of that yet. And again, it doesn't mean we aren't going to see that at some point. Just tells me we're not seeing it yet. All right. I'm going to spend a moment on this chart. This is a chart of the S&P 500. We're going to zoom in a little bit to the bottom panel because we're looking at the S&P. We're looking at the daily volume on the SPY, and then we're looking at the Chaikin money flow. Now, this shows you the daily volume reading on the S&P 500. And I think on yesterday's show, or maybe the day before, someone had mentioned the volume's not great on this current uptrend. If you're looking at the SPY, I would agree, right? The volume was strongest actually at the end of March. So far in April, we're seeing this advance being punctuated by less and less volume in the S&P 500 ETF. So the classic texts on technical analysis, books by John Murphy and Martin Pring, Edwards and McGee, kind of the foundational books about technical analysis that, the premises of which we still celebrate every trading day. They would say a big move higher needs to be driven by stronger volume. That represents big institutions starting to believe and starting to accumulate. Big funds with lots of zeros in their fund start, they add momentum, right? They actually move the needle on the daily volume readings. We're not seeing a ton of that. This is more of a lighter volume advance so far. Now, The Chaikin money flow just today starting to flip above zero. So isn't that positive? So you have to remember what this indicator is doing. The Chaikin money flow actually has a 1 month look back period. So it's looking back at like this period right here, going back to mid-March. And this indicator basically is showing you, it's tracking the change in volume, daily volume readings, but weighted by where the close is versus the highs and the lows for the day. So what's happened in the last week, we've had a number of days where we're closing near the highs of the day. Even though the volume wasn't great, it was such a big directional move that that lighter volume is actually heavier weighted. I would say the other big reason why this indicator is flipping positive finally, it's less about what's just happening now, but more about the fact that we're rolling off of the calculation all this distributed volume, all this negative volume that we saw in the first half of March. As the market was really selling off, we had a lot of big down days on heavier volume. That caused the indicator to rotate very far below zero. It has a 21-day look back. So the window is moving past some of these really big down days. So it's the combination of recent volume has been lighter, but directionally very positive, and the volume from a month ago was very heavy volume and very negative. And so by taking, those two changes are causing the Chaikin money flow to actually be quite volatile. So but my point of that is saying, I don't know if this is necessarily as bullish as you might think, because the big thrust that we're seeing higher is really more about the fact that all that negative volume from March is starting to not be in that window anymore. I would say what we do want to see is an improved volume picture, right? We want to see more up days, not just on lighter volume, but a breakout with broad participation with heavier volume. That would, give me more optimism of further upside potential. All right, a couple other charts here. Sorry, I think I'm running a little bit long on time, so we'll go quickly through it. In terms of other things to look about, volatility remains very low with the VIX below 20. Credit spreads remain very narrow. And I mentioned the interview on my Market Misbehavior podcast with Thomas Urano of Sage Advisory. I would encourage you to listen to that, particularly if you're not super comfortable with the fixed income markets, because I asked a bunch of rookie kind of 101 questions just to get him to talk about how we as investors, as equity investors, as index investors, what you should know about the fixed income markets and how you can use that information. And I thought that was valuable. One of the things we talked about was that credit spreads are coming in, and that's generally a pretty encouraging sign, because that means the bond markets are saying kind of risk on. Things are pretty good. In terms of the weekly survey data, just to catch you up here, the bulls came down a bit, down to around 30%. The bears remain steady. So the spread between bears and bulls still very much favoring the bears in this survey, but really it's more neutral at this point. It's not super negative. One big change to note in terms of sentiment changes is the fact that the name exposure index took a big jump higher, over 10% improvement in the name exposure index, down up around 79%. Last week, we were around 69%. That shift means that money managers in this survey are taking more risk in their portfolios. They're adding to the equity exposure. I think that's a bullish sign. One other ratio chart to highlight for you. Growth versus value. We talked about how growth is starting to really be a part of the story. If you look at the charts in April here on this ratio, this is the growth and value indexes. These are the pure growth and pure value indexes. Both of them are surging higher since the market low at the end of March. So this recovery that we've observed, propelling the S&P above 7,000, is really more about the resurgence in growth than anything else. And it's names like AMD that have just had incredible runs higher. AMD made a new 52-week high. I'd set an alarm for when it breaks above 270, because for me, that was pretty meaningful, because that would mean a break above the October peak and the January peak, both of which came in around 268. So today's move finally closes above 270, finally clears that resistance. I see that as a sideways period that is now resolving to the upside. The stock was up almost 8% today. We're extremely overbought with an RSI above 80. Generally, that tends to lead to some stronger returns because there's a lot of positive momentum. Good breakout in a key semiconductor name. I brought the chart of Broadcom just to show we haven't had a down day in quite some time. As a matter of fact, the last time we actually had a down close in Broadcom, I believe, was at the March low. Every one of these other, I mean, that was almost a flat day. I mean, that might be slightly lower, but it's really more nothing. And then after that, look, every one of these closes is higher, higher, higher. So we've had just nothing but up days basically since the end of March. Now, for me, I mean, is that bullish? I mean, yeah, that's good. That's great that the stock keeps going higher. But for me as a contrarian, I think, okay, all of those days, higher close, higher close. At some point, we get to the point where people are ready to start taking profits on this move, and swing traders are ready to unload a bit. That's when I think we start to get that tactical pullback. Broadcom might be one of those charts to look for that first down day, which could signal investors are not just kind of lights out laying into the AI trade. Meta and other charts like Tesla have traded up aggressively right up to key moving average resistance. Both Meta and Tesla testing their 200-day moving averages, neither of them propelling above there today. Meta has had a number of failed attempts to get above the 200-day, going back to the gap below the 200-day in October, in December, in January, and February. We were unable to get above the 200-day and stay there. So that is a threshold that has been a problem. Meta now once again with the 200-day in play. Live Nation I threw in here. This was a news a headline yesterday that caught my eye. There's a whole sort of legal issue around Live Nation and monopolizing, and Live Nation and Ticketmaster. And I'd encourage you to check out the stories for the full disclosure on. It was a big down day for LYV yesterday, and that was after retesting resistance around 167 and 168. Today, a nice bounce higher, which I think is encouraging. We'll see if it can hold moving average support. For now, looks okay. All right. Let's see if we can grab a question or two, and then we'll call it a day. Actually saw a question right when we went live. The ugly drummer, love your handle. Interesting that freight, shipping, and railroads were all quietly up today. And that caught my eye when we started, and then I completely forgot to look at any of them the whole show. So yeah, so let's look at like XPO. Woo! New all-time high today, up 5.6%, pushing above 220. Agreed. Not bad. What else would be in there? Like a trucking, like a JB Hunt. New all-time high, up 6%, finally eclipsing 235. I think you're onto something. Let's see. I mean, like FedEx, railroads, CSX. I mean, these are some pretty decent charts, right? I mean, so it's interesting in the industrial sector. These are all, I mean, these are all in the industrial sector. Some of the industrial sector has been in pullback mode a bit this week, but the names that you highlighted there, a number of these kind of at or near new highs, coming off of pullbacks and resuming that uptrend. I mean, XPO is a pretty good chart here, and that's after a pullback to the 50-day, kind of breaking out. On this kind of chart, I'm watching the momentum to see if we can get a breakout with improving momentum. A lot of these are very close to doing that. But thanks for highlighting those charts. I'm sorry I didn't feature them more on the show. I think that's a great group to pay attention to, and a group that's actually still doing quite well in the industrial sector. Thanks for that. I wonder if that huge gap on the S&P is going to become significant. A gap on the S&P. Let's take a look here. At present, it looks like both the 20 and 50-day moving averages are about in the middle of the range today. Oh, the 20 and 200-day you had mentioned. Yeah, I think you're talking about like this gap right here, right? Like this gap. Yeah. So what and I think that's a great point. You have a number of gaps on a number of charts right now. To be honest with you, what I usually focus on with gaps is I usually just kind of my general approach to gaps is to do this. On stock charts, you have the ability to draw a kind of a rectangle. It gives you like a little shaded area. This is a trick that Arthur Hill, fantastic technical analyst, taught me a long time ago as I was trying to use the stock charts platform more when I just started writing for their website. And Art, did a call with me just to get me caught up, which I really appreciate. And he showed me some of the things that he used. And this was something that was incredibly valuable. Thinking of support and resistance not as a line, which I would always do, but doing a shaded area like that. Think of it as like a congestion zone. And I started doing that for gaps, and that was really helpful. It just helps you think of that as like a pivot point, just a meaningful level around the chart. It's interesting the 200-day is right in there, as I think you mentioned in your question. So yeah, I think that's actually a really valuable area to keep an eye on, and not just on the S&P. We've had a number of things that have moved higher that also have some of those gaps, and I think those gaps could certainly come into play if and when we get a pullback, which I'm told does happen at some point during a market uptrend. We just haven't had a meaningful one since the mid end of March. It'll happen at some point. We'll be here with you when it comes. And we'll talk about what levels to pay attention to. Thanks so much, those of you tuning in live. Welcome, and I appreciate you. Thank you, those of you watching on our YouTube channel. Check out our upcoming webcast next Wednesday. You can sign up for that event at marketmisbehavior.com/leaders. In the meantime, have a fantastic evening. Be well and stay safe. We'll see you tomorrow. In the meantime, remember, it's always a good time to own good charts. Take care, folks.